You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my good friend Michael Cao. Michael Cao is the founder of Akanthos Capital Management, which used to be a hedge fund, now is a family office. Mike is sort of very well known for his views on oil and the dollar wrecking ball, among other stuff. And you've been on the podcast a couple of times before, so you sort of need no introduction. Mike, thank you so much for being on the podcast. It's awesome to have you on.
Yeah, thanks for having me again. It's great to finally meet you in person.
It was awesome meeting you. For listeners who don't know, I got the opportunity to meet Mike back in New York a few weeks ago. So that was a very cool, very thrilling opportunity. And let's get today's discussion started with something we were talking about off the record just before the podcast. You were talking about how for the last 5-ish months, you were, at least on a short-term basis, you tended to be you were bearish on oil, and oil has been one of the things that you've become well known for within the FinTwit world, and you're a long-term energy bull. However, now you're flipping from the short-term bearishness to short-term bullishness, and there's obviously recession implications, that is probably about a quarter out, demand destruction, etc. But let's get started by talking about that. So could you talk about what's changed? What's changed in, say, the last couple of months in terms of the short-term dynamics for oil?
Sure. I mean, oil, I think, is central to the inflation debate and the dollar debate. It's absolutely central because, I think the very first podcast that you had me on, where we were talking about how it was my thesis that, oil inflation in particular would lead to the Fed to become very hawkish and in turn create the dollar wrecking ball, right? So that was a theory that I had back in late 21. But starting around like April or May or whatever, I was starting to get concerned because the issue has to do with the negative feedback loop of a strong dollar itself, right? Especially on net oil importing countries, right? And so I think in August, I wrote this thread about, the possibility of an Asian contagion 2.0, which would in turn potentially create a downward demand shock. And, as you and I have talked about in the past, I always like to say the sword of inelastic supply cuts both ways, right? So you can have a situation where you have a steeply backwardated supply curve, which we still have, but we had several months ago as well. And when you have a inelastic supply curve, meaning a sudden demand shock down, that can create a very, very sharp downward move in oil. And so that was what was feeding my short-term bearishness. What's changed is that so obviously the OPEC plus decision to reduce quotas by 2 million barrels per day, that actually translates to actual reductions of around 950,000 barrels per day. Mm-hmm. So that's one. But then the impending EU embargoes kicking in beginning of December. So you may know Alexander Stahel, who's also a commodity specialist on FinTwit. He's done some really great work, deep dive on, on a sort of pipeline by pipeline basis, why he thinks the usual suspects for where Russia might reroute the roughly 1.4 million barrels per day that it's now selling to OECD Europe and Poland, where Russia, the usual suspects for those buyers are usually China and India. But Alex's work shows that it seems like China and India are just about tapped out. The one safety valve being that, you know, if China decides to fill their SPR, and there's not a lot of transparency on just how much of their SPR is filled already, that could allow Russia to reroute more. But suffice it to say that between the OPEC reductions and the potential for Russian shut-ins as a result of inability to reroute 1 million barrels per day of oil, and then by February the product embargo is going to kick in. That could potentially lead Russia to also reduce refinery runs. So Russian losses could be as high as, say, 1.8 million barrels per day. So this is a tricky thing. So from a supply perspective, I think over the next, several months, I think that the headwinds to supply are actually going to outstrip the headwinds to demand. But I'm going to say that with not a ton of conviction, just because it's so hard to know exactly when that demand destruction kicks in. Because on the one hand, this rate hike trajectory has been just unbelievable. It's happened so fast, but yet we don't really see. We're starting to see now in real time. Just I think today there are a whole bunch of layoffs being announced, right? So we're starting to see some softening in the employment numbers. But I suspect that by Q1 or Q2 is when the real economy, at least in the U.S., will really start feeling the bite of these hikes. And so I'm cautiously optimistic. I think that heading into year end and possibly the beginning of Q1, we may have a very strong spike in oil prices, and then things could soften back up again. And that leads me, it's probably a good segue to talk about the dollar a little bit, because I think my base case prior to all of these, like the OPEC plus shenanigans and the EU embargo shenanigans, my base case was that, because I am a long-term believer in this structural bull market in oil, I think that for the possibly the remainder of this decade, we're going to be faced with this sort of asynchronous core inflation and energy inflation. Core inflation versus energy inflation. This sort of asynchronous tag team effect, I call it, and that could really trip the Fed up, right? I mean, you'll initially you kind of saw, everybody was ready to pronounce the inflation already having peaked, because oil and commodity inflation started turning down. But as you and I both know, core and services inflation have remained extremely high. At some point, those are going to start turning down, possibly by next month, right? Most definitely by sometime in Q1. But I think once we get over the hump of 2023, oil is going to be in a very, very precarious state. I've been calling this this supply-demand singularity point, where even in the next 2 to 3 years, I think we will get to the point where even a recession-impacted demand number approaches, if not exceeds, the global spare capacity number. We're not there yet, but I think we're getting close to it. If we don't reach it by 2023, I think in 2024 we'll get very, very close to that point. So that asynchronous aspect between core and energy may at some points in time become a sort of synchronous wallop instead of an asynchronous push-pull. You see what I'm saying?
No, that makes sense. And so, what is interesting is, so your sort of analogy for the US dollar has been that, it's the cleanest dirty shirt around. So, as much as, people can, shit on what the Fed is doing, etc. Um, it is the cleanest dirty shirt around. And so, just on that note, we were talking about, segueing from oil, more into the dollar. So, one of the things that is interesting has been one, there's been one, a couple of years ago, the U.S. became a net exporter of oil, but then two, one thing that's been interesting has been this SPR draw, which, a lot of people have described as purely political. What's sort of your take on what's going on with, Joe Biden releasing from the SPR, and, what does that really mean, from both an oil standpoint as well as a dollar standpoint? Because is that sort of weakness on the U.S.'s part? Is that, what is, what's really going on there?
Well, I do think it is being used inappropriately for political gain, and that is one of the bull cases, right, for oil, because obviously, to state the obvious, I mean, when the SPR eventually when they eventually stop releasing SPR, and when that point of when China eventually reopens, if they ever do, that's gonna be very inflationary for the world, right? Not just for us. I think Lakshmi from Capital One, who as you know, is one of my favorite macro oil analysts. I think she put it very correctly in that the SPR was not meant to be a political weapon. And OPEC is not meant to be a sort of the OPEC spare capacity is similarly not meant to be sort of a call option on bailing the West out of its sort of bad energy policies, right? So what I find frustrating about the administration's use of the SPR is that they have, you could call it a win, right? Because they've released the SPR at an average price of, I think it was like maybe $93 a barrel or something like that. And obviously for a while, prices got into the 70s, and you could have called it a win. Maybe they should have started refilling it, but they didn't. What they did instead was tell the entire market where they would probably refill it, which essentially ensures that it's not going to go there. And the other frustrating thing about it is that from a mechanistic perspective and a legal perspective, my understanding is that they can't refill it by simply going out on the curve and buying long dated futures or forwards. They can't do that. They have to actually do it through fixed price auctions. So you can't even take advantage of the backwardation and buy forward. So it remains to be seen if and when we'll ever be able to refill that SPR. And God forbid we actually wind up in a situation a la 1973, where some geopolitical event actually happens. This administration is not well liked by the Kingdom of Saudi Arabia, is not well liked by Iran. Yeah. What if there's some kind of Middle East escalation and there's an embargo on oil, right? I mean, this literally is what happened in 73, 74, right? And then that's when we really, really need the SPR, right? When oil goes to like 200 plus, and we're not going to be able to deal with that. So I think it is a very irresponsible use of the SPR.
Mm-hmm. Yep. And since you mentioned the 1970s, one of the things that's interesting is early in the 1970s, especially with the US dollar, we sort of got out of the go back system. It was sort of the breakdown of Bretton Woods. Before we go there, I wanted to talk a bit about the strength of the US. So the US, from a resource standpoint, from a demographic standpoint, the US, at least relative to the G10 or the developed countries in the world, it does have the best demographics. It has the strongest military, etc. Peter Zeihan has talked a lot about this in his book, The Accidental Superpower, where he sort of describes how the U.S., say the U.S. river systems, for example, help connect the U.S., and then the U.S. is sort of in the perfect zone for farming, agriculture, as well as say manufacturing, etc., to happen. And just within that framework, it becomes very interesting because no other fiat, is endowed or comes from a country that is endowed with all those amazing factors. So that's something very interesting to know. That's sort of so one. Is that sort of part of what's driving the U.S. dollar wrecking ball? That's more of a long term thesis. And how so how um to phrase it this way, what would it take for considering the strength of the US, the sheer strength of the US from both the military and economic standpoint, what does it take to topple over the US dollar, being the hegemon of the global economy?
All right, so now we're going down a deep rabbit hole. I've been studying quite a bit
Love
on
your
this, and
favorite
so you
rabbit
may
holes.
you may recall, yeah, you may recall. So like last year, I wrote what one of my very first threads on the dollar was because I got into a debate about how look, you need to look way beyond just pure debt to GDP metrics to determine what a fiat currency's relative worth is. And I actually cited Peter Zeihan and Tim Marshall, who's the author of Prisoners of Geography, talking about all of these geographic assets, right? The way I think about the what drives the value of the dollar, it's really like three big categories. The first, and to borrow Dimitri Kofinis's word, endogenous. What are the endogenous factors that drive the dollar strength? And this is where you talk about geographic assets, natural resources, demographics, hard military power, soft, cultural power. Right? These are all things that lend the dollar endogenous strength. And I think this is something that's kind of interesting. So a lot of people think that, okay, Bretton Woods was kind of like a Trojan horse in a way, right, for the world to adopt dollar trade. But hey, we're going to back it with gold. And then there was a rug pull when Nixon took us off the gold standard. But I think what's interesting is if you actually look at history, the Eurodollar market started developing organically throughout the 50s into the 60s. That essentially demonstrated that there was a faith in the US dollar well beyond its gold backing, long before Nixon abandoned the gold tethering of the dollar, right? So where did that come from? Where did that faith in the fiat in the US dollar come from? It came because of these endogenous factors, right? So my point is that when you think of it from that standpoint, the subsequent abandonment of the gold standard not only didn't stymie the US dollar, in a way, you almost think of it as it kind of unshackled it. Its use actually proliferated after that, right? So those are, I guess, what I'll call the endogenous factors. But right now, as we all know, there are cyclical factors driving the dollar strength. The cyclical factors have to do with our relative economic strength, right? Which is what's allowing our Fed to be the most hawkish central bank in the world. And after last night's presser, I would say that last night's presser is probably Powell's most hawkish presser, which you wouldn't expect after taking Fed funds to essentially 4%. But I think, and I've been saying this very consistently in FinTwit, that I'm not ready to call a secular, or I guess maybe a cyclical top in the DXY until we reach a point where either the rest of the world central banks have economies strong enough that allow them to out-hawk the Fed, or something happens here that's so bad that our Fed is compelled to outdove the rest of the world. I just can't see either of those happening right now, because when you consider like the big economic zones of Europe and China and Japan, they're all in much worse shape than the U.S. So that is the cyclical factor. And then I think it's useful. I've also been thinking about the geopolitics of the dollar. And so this is really interesting. So here are a couple of miscellaneous points I should mention, right? So back in, if you think about it, a lot of the arguments for why the other countries want to bail on the dollar is that, the dollar is so strong and they're, it's causing them too much pain, or they're worried about their reserves getting confiscated. But it's kind of ironic, because when you think about the most successful competitor to the dollar, it is the euro. It's really the only sort of monetary experiment to have created a large competitor to the dollar, right? But it's ironic that its roots stemmed from the ERM experiment way back, even starting in the 80s, right?
Yep.
And originated because they wanted to hedge against dollar weakness. They were afraid of a competitive devaluation. So it was a hedge against dollar weakness, not against dollar strength. The other thing is that in 1985, right, when this is years after Volcker had spiked our interest rates and drove the dollar to the all-time cyclical high of 165 in the DXY equivalent. Everybody knows that there was a coordinated effort in 1985 called the Plaza Accords to weaken the dollar. What may be lost upon a lot of people is that actually came from Reagan. The U.S. wanted actively to depreciate the dollar to help our trade deficit. And it was Reagan who actually got Germany, the UK, France and Japan to actually sign on to that. So that was a U.S. instigated action to weaken the dollar. In 2016, less well-known are the Shanghai Accords. Shanghai Accords were, again, originated by Obama to depreciate the dollar, to prevent competitive devaluations, right? So in both of those situations where there was a coordinated intervention to weaken the dollar, they both came at the US's behest. I would argue that now there's actually a real politic reason to keep the US dollar strong, not weak. Those reasons are that, well, to borrow a sentiment from Peter Zeihan, he would say that, look, in after World War II, the Marshall Plan was enacted to help rebuild the economies of Europe, right? Mm-hmm. And it was successful. But what years later, in early 90s, what did the countries of Europe do to thank us for that? Well, they created a competing bloc, right? So I think in one of my threads, in fact, in my pin thread, the geopolitical mosh pit thread, I kind of, at the end of it, I kind of posited, I said, unpopular question. Would the US be that unhappy if a overtly strong dollar policy wound up fracturing the euro? And that's the euro. Certainly, if a strong dollar created havoc for China, which it is doing, and we can talk about that next, I think that there is a real politic reason for why I think the powers that be in the U.S. might want that. So my point is, I'm not advocating one position or another. I'm simply stating that whereas we had these coordinated efforts to depreciate the dollar in the past, I don't really see those incentives right now. If in fact I see the opposite.
Yep.
So
on that note, so when you say competitive devaluation, so what exactly are you? So you said that the Plaza Accord or the Shanghai Accord was created as something to stop competitive devaluation. So could you clarify what you mean there? So the U.S. dollar was the one that was strong. And so are you saying that China would, because the Chinese currency was weak already, so what exactly do you mean by competitive devaluation?
The yeah. So sorry. That's the idea behind that was in both cases it was to better our current account situation. So that's what I meant by that, right?
Okay, got it. And yeah,
Yeah.
so moving on to China from the US. So one of the things that is interesting about China is China. So one, we had the CCP meeting earlier this month, earlier this month, last month. Now it's November. But essentially, when we start thinking about China, so China is sort of or China or the Chinese government sort of wants China to become sort of the second pole of the world. And if you sort of subscribe to the view that the world is now moving towards a multipolar type scenario, China is definitely trying to definitely trying to gain dominance over at least some part of the world. So one of the things that was interesting was. If I remember correctly, Saudi Arabia was willing to sell oil to China in yuan, which I think was a big first because considering how much oil China consumes, it's very interesting that countries like Saudi Arabia are happy to sell oil in yuan. The US, the advent of the petrodollar that came about because of the oil being priced in US dollars. We're starting to see that change a little bit. So what do you think? What do you think is going on with China? And what's sort of your view on on the Chinese yuan, especially from a long-term standpoint. As much as it's not viable because, China is a very hostile neighbor that's willing to do anything to better itself at the expense of others. And as much as it's very likely not going to become a widely accepted reserve currency. It appears as if the sort of increased dominance of China over countries like Saudi Arabia, minor countries in Africa, Sri Lanka, Pakistan, etc. It is definitely a little bit worrying or a little bit concerning to me.
I think China is in a every central bank in the world is in kind of a box right now, right? Because every central bank is dealing with a lot of debt and is dealing with the big inflation problem. China, I would argue, has the biggest problem of all, right? Because their private debt situation is the worst in the world. Much of it, a lot of their debt is also dollar denominated, by the way. So they have a big problem there, and so their central bank is you would think would welcome the devaluation of the yuan just to better their current account situation. But what is a tell in terms of what I think is really what is scaring them is that they've been intervening to weaken the dollar, right?
Mhm.
And to strengthen the yuan. And by the way, their interventions haven't met much success because every time they intervene, just like every time the Bank of Japan intervenes, they maybe get a respite for a couple of days, and then all of a sudden,
Goes back up, yeah.
the yuan is back to the lows. So I think this is the problem. So with respect to Kingdom of Saudi Arabia, for instance, doing token deals in yuan, I think that those are more symbolic than anything because at the end of the day, the Saudi Arabia real is a hard dollar peg. The Chinese yuan is kind of like a soft dollar peg. They're still on the dollar standard, and for them to hold here's another thing that's interesting. I think that in the aftermath of the Plaza Accords, when the dollar depreciated massively from that 1985 peak, what then happened was there was an oil crash because Saudi Arabia, I think, was scrambling to make up for declining sort of dollar based revenues, and they were essentially trying to recoup by pursuing market share. So they
Mhm.
wound up actually crashing the price of oil. The right now, I think that Saudi Arabia is kind of laughing its way to the bank. As much as they hate Biden, they're laughing their way to the bank because not only are oil prices in a secular bull trend, they're riding the strength of the US dollar wrecking ball. And why would they actually trade that for a currency that's non-convertible, and if it were freely convertible, would likely devalue by 30% at least. So I'm not really seeing them doing anything drastic there. I mean, that certainly could change, I guess, but I think it would take a lot because China has a lot of problems longer term, right? We all know about the demographics. We all know about Xi having pulled a Palpatine move, in the last 2 weeks, right? And so you see the implications of that and the implications of China. The implications of foreign direct investment into China, right? So capital wants out, not in. The only reason why the Chinese yuan still has a 7 handle and not an 8, 9, 10 handle on it is because they have very strict capital controls.
No, that's 100% true. And so, one of the things that's interesting about China is the problem you mentioned. We're finally starting to see some signs of their massive real estate bubble come down. And it's interesting because, she is not or does not seem to be too willing to bail out the real estate, the overly leveraged real estate developers. When I spoke to Marco Papik, a few months ago, he talked a bit about how how the CCP meeting could change a lot because if you put people who are pro bailout in important positions of government, she may or may not be as important as he used to be. So that's something that's interesting to think about. And longer term, well, one thing that's definitely true, as you mentioned, is the Chinese demographics do not look good. And
well, there's something that's very important to talk about here in terms of China. I mean, when you look at China's history, like big picture history, like over the millennia, right?
Mm-hmm.
中国 is Middle Kingdom. That's what China. That's how you say China in Chinese, yeah. Right? And so if you think about China from that Middle Kingdom perspective, for most of its existence, it has been very inwardly focused and has had this view that we don't need anybody else. We can, we don't need the outside world, right? And so what I saw happen with Xi in the last couple of weeks is that he's definitely moved away from the sort of more Deng Xiaoping sort of capitalist types of reforms. I mean it's obvious that it's been moving in that direction, but I mean he really underlined it with a big red highlighter, right, a couple of weeks ago. And so that makes me kind of wonder just how much, like everybody's calling, oh, China's got to reopen, they're doing damage to their economy. I don't know that he cares. I just don't know that he cares. I think he's much more concerned about social control and basically, not having a restive population. Now, you could argue that it may require economic sustenance to avoid mass riots. I think a couple of months ago, one of my sources on the ground was indicating that the 16 to 24 male cohort has something like 20-25% unemployment. That's a restive population and a dangerous element, right? So maybe the only way to do that is to have economic health, but maybe not, because the emperor is in charge. So that's why, like, when we started this conversation, we're talking about oil. I don't want to have the hubris to say that, for sure we're going to this reduction in supply is going to outstrip any sort of demand destruction. China is kind of a big wild card. If they do reopen, it's really going to juice the supply demand situation in oil, but they might not reopen for a while. I just don't know. I don't think anybody really knows.
Yep. Yeah, no, that's that's one of the interesting things. And one thing is, is there ever going to be, a scenario where, so for example, Michael Pettis has highlighted how Chinese domestic demand as a whole is becoming extremely weak. One of the things that's interesting about China is that export, so as much as we see, China has the world's largest trade surplus, new record trade surplus for China. Whatever they're making off of exports, that's not necessarily being recycled into higher wages for consumers, and therefore, partly because of the lockdowns, partly because we're not seeing higher export earnings get recycled into higher wages for Chinese workers. We're not really seeing strong macro conditions even in the domestic aspect of China. One thing that's interesting is you know, if macro conditions, at least in the US, get so bad by the time the Fed pauses, what does the rest of the world central banks do? And one thing that I think you've highlighted in a tweet is that the rest of the world central banks will likely be easing by then. Why do you say that?
Exactly. Well, because of exactly the cyclical nature, the cyclical imbalance between the economies right now. Because I think the U.S. Not only is the sort of least dirty shirt from a sort of debt to GDP perspective. From an economic perspective, it is stronger than China. It is stronger than Europe. It is stronger than Japan, stronger than England. I think I was on a Twitter Spaces yesterday, and Fed guy Joseph Wang put it this way: monetary policy is going to have much more efficient transmission in these other countries, primarily because of their specific weaknesses, right? So we already know the Bank of England's Achilles heel, right, with its pension system.
Yeah.
The eurozone just a couple of weeks ago hiked for the second time, taking their policy rate to, I think, 150, right, 1.5. That's what, like a 75 basis point hike. But then I remember seeing the headlines. Yeah, they're thinking about a pause in December. I'm like, what are you talking about, right? So I really do think that that's the reason why you can't count out the dollar wrecking ball. Even if the Fed, let's pretend that we didn't hear Powell's presser yesterday, where he's in his presser, right, in case anybody missed it. He basically said that, like, if the dot plots would probably be higher, not lower, right? But at any rate, let's assume that we didn't hear that, and let's assume that, he's going to pause today. If he paused today, one has to assume that he's seeing something so bad that likely the rest of those areas, Europe, Japan, and China, it's not like they're shielded from these same macroeconomic forces. They're likely going to be in full-blown ease mode. I mean, Japan already is. Okay. And China already is. Yep. So the question is, places like England and the UK and the ECB. And I would say that, the ECB has been kind of granted a little bit of a respite in recent weeks because of weather. I think, honestly, that millisecond, for a couple of milliseconds, we saw the euro climb back to like 101. Honestly, I think that's weather. I think that it's the fact that, maybe they are going to make it through this winter without having serious problems because the weather's been so nice. But if the weather turns very, very cold, and this is still the beginning of winter, I think there are going to be some serious problems. One of my friends was just telling me this anecdote of a German company that it's a small 25-year-old family business that typical net profit margins are €1 million per year. Last year its energy line item, which is its primary cost line item, was €800,000. This year it's gone from 800,000 to 3 million. Okay, they're done. They're done, and there's no support from the government. There's no support coming from the government because, and this is a small sort of mom and pop type business, or a smaller type of business, but you're seeing even big industrial giants teetering there. So I think the Eurozone is in a serious bind, and the chickens haven't come home to roost yet, because it's going to really be interesting to see what happens when the Fed takes our policy rate to 5%. Like, what central bank is going to be able to match that?
No, yeah, yep. And just to add to that anecdote, one thing that's interesting is seeing a lot of these companies talk about how FX, or companies that do business internationally but are based in the US, talk a lot about how FX is actually affected sales quite significantly when you convert, say, stuff sold in Europe or China into US dollars. So I think that's another thing that's interesting to note. But going back to the US dollar is, there's a couple of other interesting things. Going back to what you were talking about, geopolitics. One thing that you've talked about on Twitter is that how you were starting to think that we're starting to see this weaponization of Fed policy, especially as it relates to the US dollar. When the Federal Reserve sets interest rates, it's not just setting interest rates for the United States, but it's actually setting interest rates for essentially the entire world. Where the US dollar has massive implications for, say, emerging markets, as well as countries that trade with the US, which is almost every country in the world. So, with that, keeping that in mind, could you talk a bit more about, how Fed policy is increasingly becoming a geopolitical weapon, but it's sort of being portrayed as an excuse to fight inflation?
Well, okay, so I wouldn't go so far as to say that it's actively being used as a weapon, but I will say that the way you put it, because it is weakening adversary and frenemy alike, I think that there isn't necessarily a geopolitical pushback to weaken the dollar like there was in 1985 or 2016, right? So I'm not ready to actually say that we're actively weaponizing it to strengthen it, to like topple everybody. But I am saying that if that happens, I'm not sure that the U.S. minds. Okay, and so that, to me, okay. So I want to call attention to my current pin thread is entitled "Geopolitical Mosh Pits and Sovereign Endgames," and in it I was talking about how because of these differing incentives and in terms of where we are cyclically, it's creating all of these conflicting incentives between central banks, right? Mm-hmm. And so back in July, if you remember, when the yen first hit 137 or so, I get a call from one of my contacts who told me very credible source told me some interesting color about how the Bank of Japan had essentially enlisted the Fed's help in allowing the Bank of Japan to buy our 10 years, U.S. Treasury 10 years, to effectively paint a picture, and stymie the relentless decline in the yen. So if you remember, that then sparked this massive risk rally, right? Everybody's saying that, oh, and then there was a rally in the 10-year rally in risk that lasted, for weeks. But then when I got a call a couple of weeks later, I got a call from the same source saying, you know what? I don't know that they're going to be able to hold the line. Like plunge protection team, the Fed, who knows, right? I don't know that they're going to be able to hold the line. And sure enough, within a week, you saw the yen crash to new lows, the 10-year collapse, and the market completely turned down.
Mm-hmm.
So I think what we saw in October was a mini version of that. I've been calling that the intervention matrix, right? Where the market.
Come up with these awesome names.
Yeah, well, either the markets are I'll call this sort of amorphous cabal the plunge protection team, right? So whether it's the central banks or whoever it is, right? They're trying to basically paint a picture and show that, hey, you know what, things are just peachy, and then the minute they kind of let go, things start getting bad again. And so that I'm wondering, one of the things that I've been looking at, and full disclosure, I have a position in VIX via this UVXY, as been wondering why vol has been so well behaved, and vol has actually been going down. And I'm wondering whether this is also part of the sort of, the picture painting that's going on here. It's all very strange and noisy to me. And I'm not sure, to carry that matrix analogy, I'm not sure whether yesterday's Powell presser represented the market, taking the red pill, or whether we're still in that intervention matrix. I'm not sure.
Yeah, the joke on Twitter was that there was a pivot, but it was a pivot from hawkish to more hawkish.
Yeah, exactly.
Yep.
Exactly.
Yeah, and on that note, we've talked a lot about sort of the relationship between the U.S. dollar, China, global geopolitics. When it comes to actual real world business, I think you have touched upon occasionally on Twitter about how the US dollar wrecking ball makes the rest of the world more competitive, but it also adds, or it also proliferates this reshoring trend. Partly that partly started because we observed supply chains collapse in the aftermath of the reopening post the COVID lockdowns. But you've also talked about how the US dollar wrecking ball creates an incentive for reshoring along with making the rest of the world more competitive. Could you expand a little bit on that?
I mean, it's all interrelated, because I think that part of the reason, this breakdown of the sort of post Bretton Woods anomaly, I should say, right? The last 70 or 80 years of you could call it a Pax Americana, or this period where we've essentially had no wars, a period of geopolitical calm that seems to be ending, right? With this multipolar world and deglobalized world. Mm-hmm. It's all adding to frictions, and especially catalyzed by the Russia-Ukraine war and the potential conflict between China and Taiwan, and now potentially a conflict in the Middle East between Saudi Arabia and Iran, right? Now that the US has essentially withdrawn from that region, it'll devolve into another geopolitical mosh pit. You've got three geopolitical mosh pits. You've got Ukraine, Russia, China, Taiwan. Oh, you've got a fourth geopolitical mosh pit. It seems like every other day, North Korea is lobbing missiles over Japan now. So what the fuck is going on here? Right? So So it's definitely getting to be kind of a scary world. Certainly a world that it doesn't really make sense to me, given what we're seeing with the economic situation and the vast hiking that we're seeing. I kind of got off track with your question. You're talking about like reshoring. So yes, this is all putting into focus how important it is for us to reshore, and I think the days of sort of just-in-time inventory are no longer really mentioned in business schools these days. Now it's more like talking about redundancies. But all of that is going to be inflationary. So it's all intertwined.
Yep, it really is. And so, just on that note, I wanted to shift away from talking about markets and, start to wrap up the podcast here. So I wanted to first ask you, when it comes to subjects like this, so you spend most of your life as, so you initially started off in commodities and then you moved on to relative value, convertible arbitrage, which is what you spent most of your hedge fund career doing. And then, now now you started thinking a lot more about macro, oil, the US dollar, etc. When it comes to say books and a resources standpoint, what are the best books and the best resources that you have read, that sort of helped you better understand, the things that are going on today?
Like what, finance books, macro books?
Overall, well, macro as well as just just books in general, because I see a lot of books.
Just books in general. Oh yeah. I'm a huge avid reader. I'll
Yep.
Here. Okay, so I'm a very, very avid reader, and I'm usually in the middle of like 3 or 4 books at the same time. So let's see. One of my all-time favorite books, when I used to interview prospects for my company, I had a reading list that for new hires. And if I remember, so at the top of the list was Reminiscences of a Stock Operator.
As it should be.
As it should be. I've probably read that book 10 times. And I think the takeaway from that book, even though it was written in the 1930s, was it? That markets change, market dynamics change. What never changes is human greed and fear. Yep. And so I think that's super important. Let's see. I've obviously, when I started my career, I read everything I could about everything. So I read all the Market Wizards books. I read, stuff like, Den of Thieves, Liar's Poker, all the quote fun books. But then I also read a lot of sort of like how-to books. So I think one very important book on options that I read was Sheldon Natenberg's Options Volatility and Pricing. Yep. Yeah, that's just a great pragmatic book, as opposed to like all the stuff that you get in business school that's all like on theoretical, pricing models and whatnot, right? And then like, now I read a lot on geopolitics. I just read a book recently it's very dense but very, very good. I don't know if you've read this book called Disorder by Helen Thompson. Oh, it's excellent. But like I study it. Like, you see how much I like dog ear. So that was a very, very good book. But like very dense in terms of just the amount of material.
What are the more unconventional books you recommend? So I think, the conventional ones are always like Market Wizards, and as you mentioned, Edwin Lefebvre's Reminiscences of a Stock Operator.
Yeah. I mean, I've read like a ton of oil books. I read a lot on financial history. Mm-hmm. I'm currently in the middle of
The Price of Time.
This one.
Lords of Finance. Yeah, that's a great one. Yeah.
But I also like to read like on my nightstand, you're gonna laugh. I'm reading the Silmarillion. You know what that book is, right? That's the Tolkien's beginning book. So
Okay.
I like to that's like the creation story of Middle Earth. So I like to read creative stuff. But you know what? I go through these phases. I'll do like I think like last year was it? I probably read like 4 or 5 books on like quantum mechanics because I listened to a bunch of like Lex Friedman podcasts and I got totally enchanted with like string theory and all sorts of stuff like that. So I read a whole bunch of books on that, and then I'm a big fan of just like just thinking about like mental models and reading stuff from different disciplines. I went during COVID. I watched that Netflix documentary on My Octopus Teacher, and I'm an avid scuba diver, right? So I got so captivated by octopuses that I wound up reading I think like 2 or 3 books on cephalopod intelligence and evolution. Um, it's just so fascinating. It's so fascinating. So I'll go down these like rabbit holes. And then like a couple of years ago before that, I went down the rabbit hole with climate change. I read a whole bunch of stuff on like climate and the whole like where Michael Mann came up with the whole hockey stick and all that stuff. And I have some opinions there that I won't get into here, but anyways, so I'll do these deep dives on all kinds of different
And you
disciplines.
mentioned oil, you mentioned that you've read a lot of oil books. So, what are the best ones that you would recommend? So is it, The Prize by I think Daniel Yergin?
Yeah, I have like a whole. I've read let's see, the Twilight in the Desert. That's another a good one. Let me see here. I have a whole. I actually keep like these lists of books that I've read.
You should publish these lists on Twitter. That would be.
I do. I actually have them. And then I got I read one thing that's super interesting is I read How to Change Your Mind by Michael Pollan about psychedelics and the science of psychedelics.
Wow.
That was super, super interesting. So yeah, it actually prompted me to go on a retreat. Yeah. So
Awesome.
yeah, I have broad interests.
Yep, you truly do. And Mike, just on that note, I think ending it on a positive note is always a good idea. As opposed to talking about why the U.S. dollar is sending the world to hell. Now with that though, thank you so much for being on the podcast, Mike. It was a pleasure having you on again.
Always a pleasure.
Yep.